Hi there, welcome to Kneppy Invest and welcome to my pursuit of high quality companies that are not listed on the ASX, primarily focused right now on the London Stock Exchange, Tokyo Stock Exchange, and a few companies on the NASDAQ I've never heard of before, including the focus of today's video, which is Nova. Never heard of this company before. Fairly big, about $8 billion market cap. They have a nice picture of a car coming in and out of frame or whatever. Whenever innovation happens, Nova is redefining the limits. Doesn't tell me anything about the company. So what I'll do in this video is I'll briefly discuss what this company does, have a look at why this company satisfied my Fiscal AI high quality screener, which I'll talk about in a second. Then we'll have a look at the financial metrics, or the rest of the financial metrics, and then we'll have a look at the chart. And this particular screener is highest quality screener. Here it is. Here it is. So just focusing on revenue, return on invested capital, operating margins. I call this screener rule of 10, and I want revenue growth to be above 10% per year, return on invested capital and operating margins 5-year averages to be above 10%. Only for companies with a market cap above $100 million and excluding mining. And Nova was one of 94 listed and NASDAQ listed companies that satisfied this screener, including NVIDIA, Microsoft, Alphabet, Meta Platforms, Tesla, for some reason, Netflix, Intuit, but you have to go down a long way to get to Nova. Now, the reason I chose Nova is simply because of some of the metrics, and we have to go all the way down. So there was really nice growth. And in revenue, 27.4%, and return on invested capital and operating margins 5-year average have been above 20% over the last 5 years. So just because all three metrics were above 20% is the simple reason why I chose Nova. By the way, according to Fiscal AI, the industry Nova is in is semiconductors and semiconductor equipment. There we go. So that sort of makes sense. Sort of makes sense why this company has done really well over the last 5 to 10 years. Okay, so let's have a quick look and try to understand what this company does. So apparently, according to the website, they are a leading innovator and key provider of advanced metrology and process control solutions used in semiconductor manufacturing, leveraging insight to generate foresight. There you go. We partner with our customers to provide precision and clarity in the most complex challenges. There you go. About us. You could have a look at this. Story about driving innovation. Ooh, okay. So they help with automation of cars, I suppose. No idea. Let's have a look at their products. Dimensional metrology, materials metrology, chemical metrology, and software solutions. What the heck is dimensional metrology? I have no idea. I'm trying to get to it. Advanced multidisciplinary dimensional metrology technologies combine complex optomechanical hardware with advanced optics and cutting-edge algorithms to continuously innovate for effective process control throughout the semiconductor fabrication lifecycle. Okay, way over my head. Hybrid metrology, spectral interferometry, optical scattrophometry, and advanced imaging. Okay, so most of this stuff is over my head. So all we do know is they help provide services and technology and products for the semiconductor space. Now, what I'm going to do now is have a look at what Fiscal AI says they do. So they design, develop, produce, and sell process control systems used in the manufacture of semiconductors in Israel, Taiwan, USA, China, Korea, and internationally. It includes a set of metrology platforms for dimensional films. Now, what is metrology? What is metrology? Maybe that's funny enough. I'm a meteorologist, so I'm very close to being or understanding what metrology is. But missing a few E's and O's. Specialized mechanical structure designed to accurately position and hold a test object for measurement and analysis. Okay. So there is a lot of stuff I don't understand when it comes to this, but just because I don't understand it doesn't mean you can't invest in it. I don't believe in that. I don't believe you should just invest in companies that are in your wheelhouse, because otherwise I'd be investing in no companies at all, because I don't understand any company completely. Okay, so let's see why this company satisfies my filter, my high quality filter. We already know really nice growth in revenue. Their margins are pretty nice. And what's the other thing that was really nice? Oh, the quality metrics were pretty nice as well. Return to equity, return on invested capital. Now, revenue growth 27.4% over the last 5 years. Now, 3 years, only at 16.5%. So maybe a little bit of a slowing in the growth in the last few years. So if this continues, and this is something to be aware of, earnings per share growth at 23.4% over the last 3 years, 38.8% over the last 5 years. So a bit of scale we've seen. You can definitely see that over the last 5 and 10 years. The earnings have been growing at a greater rate than revenue. So more than likely, margins have been growing as well. Gross margins 57%, operating margins 28.9%. I would like operating margins to get a little bit higher than that, and maybe they have been growing over the last few years. Now, this is a 1-year sample of margins. I do prefer looking at the 5-year history, particularly any sort of trend. So I'd like to see operating margins increasing, and I expect they will be. Gross margins, you don't want to see gross margins dropping through time. And return on equity, return on invested capital, 5-year average above 20% at 22.9 and 23.1%. And that's exactly what we want to see. And of course, again, we don't want to see that dropping. Any debt? No, it looks like they have net cash. So debt is not a problem. And no dividends, which is fine with me. No dividends. Exactly what I want to see. Now, next thing I'm going to look at is the financial history of this company. So everything is green, all green flags, no red flags or significant red flags just yet. This is the revenue and profit history of this company. Now, what I'll do is I'll get rid of the last 12 months. And so we're just looking at a 10-year history, just a 10-year history. And this company's revenue has quadrupled. Yes, more than quadrupled, from 148 million to 672 million. And the profit has gone up tenfold. So straight away, margins have expanded. We already knew that. So profits have gone from 15.7 million to 183.8 million, and they're still growing. Now, on occasion, you just see the revenue and the profit drop. We saw that in 2023, but over time, they've been increasing. So yes, another 2 green thumbs, or thumbs up, not green thumbs. Now, I'm not a gardener. Now, I fully expect gross profit margins to be, well, sometimes I have no idea, but really not going up or down. So no red flags here. If we saw gross profit margins decreasing over the last 10 years, that would be a bit of a red flag. Sometimes not a massive red flag, but I fully expect to see operating margins to have been increasing. And we have seen that, yes. Operating margins have been increasing over the last 10 years, up to 27.9%. And I might think they could increase even further from here. 27.9%, there's definitely room for growth here. But operating margins have gone up threefold in the last 10 years. Okay, next thing, I'm just going to have a quick look at cash flow. Now, one of the reasons I look at operating cash flow and free cash flow is I just want to see if there's any sort of big one-offs. I also do that with profit, but the reason I do this is I just want to see if potentially free cash flow yield and EV free cash flow might be obsolete. They might not really show a true picture of the valuation of the company. And both of these metrics have been going up. There was 1 year, 2016, when they were both negative. So this company was, in fact, operating cash flow and free cash flow negative that year. And I have no doubt there would have been some investors or shareholders panicking. Oh my God, we've gone from highly cash flow positive to negative. Oh my God, we got to sell. Run for the hills, run for the hills. Okay. So no significant red flags there, even though it's in Christmas colors. What else? Okay. Return on invested capital and return equity history. Now, we want to see this not decreasing. Get rid of that. Oh, I actually clicked on the wrong ones here. We don't want to see this decreasing, and we don't. So, in fact, they're fairly identical. Now, over the last 10 years, typically, return on invested capital has been higher than return on equity, but they're nicely above 20% right now. And generally, they have been above 20%. On occasion, return on equity is below 20%, and only 1 year has return on invested capital been below 20%, and that was last year. But generally, nice, very nice for this company. Okay, so no significant red flags now for this company. What about valuation? So let's have a look first at PE ratio. And, okay. So what we want to see here with the PE ratio, in fact, I'm going to take it back to last 12 months. So it goes to now, and I'll record this video on the 21st of August. So PE ratio is about 33. It has been as low as 17 back in October 2022. And remember, that's when the share prices of many companies like this was dropping because of rising interest rates. So that's a nice valuation for this company. Recently, probably in April, early April, valuation or P ratio is 24.4. Now, the P ratio has been as high as 55 quite consistently. So that does seem to be sort of the top end range of P ratio, and Nova is well below that right now at 33. So I wouldn't say this is cheap nor expensive right now. Now, back in 2019, by the way, P ratio got down as low as 12. So obviously back then, the market didn't think much of Nova, didn't think this company had much growth. So really over the last 5-6 years, the market has changed its opinion of semiconductor businesses. Now, we could go through some of the others, like free cash flow yield, some of the other valuation metrics. Free cash flow yield, 2.8% right now. So I'd like that to be 2.8% is okay. Nothing untoward there. But again, not at the low end, not at the high end, but we expected that. And if we have a look at EV to free cash flow, probably the same thing here. Now, a big spike in 2020. So this is why I sometimes look at free cash flow. Was that the year that was negative? I can't remember now. Let me go back to free cash flow, which is not here. Did I delete it? Okay, so let's have a look at EV to EBIT and just see if this is sort of similar to the PE ratio, and it is. It's at 28.67%. And you can see it fairly low before 2020. So obviously this company didn't have much premium to its valuation. The market wasn't really willing to pay a high price for this company. So that has changed in the last 5 to 6 years, but EV to EBIT sort of in the mid-range of the range in EV to EBIT. So neither expensive nor cheap. Now, do we get sort of the same feel when we look at the chart? So we're going to look at the weekly chart for Nova. Now, the ticker code for this company is NVMI, and this particular weekly chart goes back to 2016. Now, if we go back to 2016, now even at this point, between 2008 and 2019, this is actually sort of the chart of a high-quality company. Now, I don't know when this company listed. Looks like listed quite a while ago. But prior to 2010, no, this was not the chart of a high-quality company. In fact, I wouldn't have taken a second look at this company. So it looks like the fortunes of this company changed after the GFC. And really, since then, by the way, you could have bought this company for $6 back in 2012. Current share price, $246. So the valuation of this company has increased 40-fold over the last 13 years. Well, that is the sort of company you want to own for the long term. So the question becomes, can this company keep on growing? And is this company cheap? And we've already looked at the valuation metrics, and I said probably not, probably midpoint. And I think this particular chart confirms it. Now, I would say if the share price gets towards a 200-week moving average, good time to buy. We saw that during October 2022. Remember, that was sort of like when the P ratio got below 20. That was a good time to buy. Got very close in October 2023 and very close in April 2025, so not that long ago. And the share price went up, almost doubled. Share price did too high recently. Looks like almost a double top there. Share price has pulled back over the last few weeks, but maybe a buy the dip situation, just maybe. Anyway, so I don't mind this company, but in terms of valuation, I probably wouldn't be rushing to get out this company or buy this company just yet. Okay, so that's all I have for this look at Nova. Nova MI looks like, or just Nova. That's the T code, MI. Anyway, Nova, Process Insights. Interesting look at this company and dimensional metrology. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.